Thanks for watching Income Method Basics from High Dividend Opportunities. This series has been curated to help you understand investing concepts and our methodology. My name is Will Barton, and I am the lead analyst at HDO. In this episode, we're talking about debt and why it can be an important tool for income investors. When most people hear the word debt, they think of borrowing money. But for investors, debt can mean something very different. When you invest in debt, you are generally lending money to a borrower, either directly or through a fund, a bond, a loan, a BDC, a CLO, a mortgage-backed security, or another income vehicle. In exchange, the borrower agrees to pay interest and in most cases repay the principal at maturity. That is what makes debt different from common stock. A stockholder owns part of a business and participates in the upside and downside of that business. A debt investor is focused on something more specific, getting paid interest and getting repaid. That does not mean debt is risk-free. Debt prices can move up and down, especially when interest rates change. When rates rise, older debt with lower coupons can become less attractive, so market prices may fall. When rates fall, existing debt with higher coupons can become more attractive, so prices may rise. That is why trying to perfectly predict interest rates is so difficult. Even professionals and policymakers can get rate forecasts wrong. The goal is to own a diversified mix of income-producing investments that can perform across different environments. Debt can help because there are many different types. Some debt is fixed rate, meaning the interest payment is set. Some debt is floating rate, meaning the payment can adjust as rates change. Some debt is secured by assets, such as real estate, equipment, loans, or other collateral. Some debt is unsecured, meaning investors rely more heavily on the borrower's overall financial strength. Some debt is senior in the capital structure, which means it has a higher claim on assets if something goes wrong. Other debt sits lower in the capital structure and may offer higher yield in exchange for higher risk. This is why income investors should not look only at the headline yield. A higher yield may reflect a better opportunity, but it may also reflect higher credit risk, lower liquidity, or more uncertainty around repayment. The key question is simple: are we being paid enough for the risk? Debt can also create opportunity when market prices fall. If a debt investment was issued at par and is expected to repay at par, then buying below par can potentially increase the investor's total return. But price alone is not enough. Investors still need to understand the borrower, the collateral, the maturity date, the interest rate, and the likelihood of repayment. Unlike growth stocks, where much of the return may depend on future price appreciation, debt is usually designed around contractual income. The borrower owes interest. The borrower owes repayment. That structure can make debt a useful part of an income-focused portfolio. For HDO, debt-related investments can include bonds, baby bonds, preferred securities, senior loans, BDCs, CLO funds, mortgage-related investments, and closed-end funds that specialize in fixed income. Each one behaves differently. Some may provide higher current income, some may offer more stability, some may benefit from higher rates. Others may benefit when rates decline. The takeaway is simple: debt is not just something borrowers use. It is also an investment category that can help income investors generate cash flow. But investors need to understand what they own. Look beyond the yield. Ask what backs the debt, where it sits in the capital structure, how interest is paid, when principal may be repaid, and what could go wrong. Used correctly, debt can be a valuable tool for building an income-focused portfolio. The goal is not to guess every rate move. The goal is to own investments that can pay you along the way. To put this income method lesson to work and to unlock our full portfolio, consider subscribing to High Dividend Opportunities on Seeking Alpha.